So, welcome back after the break. Now, two more questions that they can ask you for 4 marks. Question would be like this, which they have asked in the exam also in the past, that an entity sells a financial asset where the transferor retains a call option to repurchase the transferred asset at the transferor's option, where the option is deep in the money. Okay. The question will be whether the financial asset will be derecognized or not. Now, for those who have not studied derivative chapter in a strategic financial management subject, call option means a right to buy. In the money means the market price is more than exercise price. And as you know, call option is exercised when market price is more than exercise price. So the seller of the financial asset is also holding a call option, and the time is say 3 months. What is the likelihood that this option will be exercised? High probability or low probability? High probability, because market price is 200, which is 4 times your exercise price. So deep in the money means there is a huge gap between these two numbers. So even if in 3 months the price will fall from 200, will it fall below 50 and becomes out of money? Chances are very less. In 3 months time the price will not fall from 200 to 50. It may fall by some amount. It can even fall below 50 also. Not an impossible event. But probability is very low. Is it right? So therefore it means this option will be exercised. The option will be exercised because market price is 200. And after 3 months, let us say worst case scenario, the price goes down to 100 rupees also. Still you have a right to buy at 50 rupees. Are you going to exercise the option? Will the seller exercise the option? Yes. So option will get exercised. Now here the option will get exercised means you are going to buy that asset again. Asset will come back to you. Asset is going to come back to you. So are you going to derecognize this financial asset at the time of sale? The answer is no. In this case, it is not a sale transaction. It is a financing arrangement. So basically what these two parties must have done, A would have sold the asset to B at say 45 rupees. It would have entered into a call option to buy back it at 50 rupees after 3 months. So effectively what you are doing, you are taking a loan of 45 rupees and giving your asset, means that asset is used as a security, collateral, because you are selling the asset to B, B becomes the owner of that asset. But you put a condition that I have a right to buy this asset back after 3 months at 50 rupees. You are going to certainly buy that asset because market price is 200 rupees. You can buy it at 50. So what is the reason for charging 5 rupees difference? This is the interest which Mr. B is charging to A. So in this case, when you will receive this 45 rupees on sale of the asset, you will treat it as a loan. Bank account debit 45 to loan from B 45. And you will not write bank account debit to financial asset. We will not derecognize. Rather, the amount received today will be treated as a short-term loan from B, and when you will repay after 3 months, you will write loan from B, debit 45, interest debit 5 to bank 50. You will exercise your right to buy that asset at 50 rupees. So you pay 50. It is nothing but repayment of loan. 5 rupees difference is the finance charges, the interest cost. Okay. So do not derecognize. Because in form it appears as if it is a sale transaction, but in substance it is not a sale transaction, it is a financing arrangement. Is it right? Substance over form. We have to disclose it as a loan taken from B. Financial asset remains in our book at its existing carrying amount. A reverse example for put option. A sale of a financial asset where the transferor issues or writes a put option. Just I will revise put option quickly. Put option means right to sell, but not the obligation to sell. There are two parties, holder of the put option, writer. Holder has a right to sell, writer has an obligation to buy. If holder wants to sell, writer has an obligation to buy. And now let us put some number. Exercise price is 100 rupees and market price is 20 rupees. Okay. A sells financial assets where the transferor writes a put option that obligates it to repurchase the transferred asset at the transferee's option, where the option is deep in the money. Is the option deep in the money in this example? So first you should know when is put option exercised by the holder. Put option gives you a right to sell at the exercise price. So you will exercise your right when market price is below the exercise price. Now in this example, the holder of the put option has a right to sell the financial asset at 100 rupees. But the market price is 20. Now it is deep in the money right now. Why it is deep in the money? Because the gap between the exercise price and market price is very high, 80 rupees difference. And suppose the time is 3 months or 6 months. So there is a very little probability that in 3 months time the market price will exceed 100 rupees. It has to increase 400%, by 400%, only then it will exceed 100 rupees, which means the option will be exercised. There is a high degree of probability that the option will be exercised. If the option will be exercised means the holder, in our example the transferee, the buyer of the financial asset is going to sell it to you, which means the seller of the financial asset, who is the writer, has to buy it, So asset will come back to this seller of the financial asset. So when the asset will come back to it, it means you are going to again have the same risk and reward associated with that asset. So do not derecognize. If there is a probability, high probability that you will get the asset back, then do not derecognize. And again, whatever amount you received on the sale of the asset will be treated as loan from B. So same entry, I am not writing again. Bank to loan from B, amount received, and on repayment, loan to B, interest account debit to bank account. Okay. Now 2 questions for you. During the reporting period, entity A has sold various financial assets. Required help entity A by evaluating the extent to which the derecognition is appropriate. In each of the above cases. First question is, entity A sells a financial asset for rupees 10,000. There are no strings attached. No strings attached means no option, no guarantee. You just sell the asset and receive the money, and we have no obligation with that asset anymore. So no rights and obligations are attached with that asset now. So will you derecognize the asset immediately? Yes. This is a very simple example. Entity A should derecognize the transferred financial asset because it has transferred all the risk and reward of ownership. Is the answer printed? Okay, now on the screen only. First you read, think. This is little complicated, whether we should derecognize the financial asset or not. 4-mark question. Entity A sales an investment in share for rupees 10,000. Okay. But retains a call option. Call option means you have a right to repurchase the share. But at what price? Check that. At any time at a price equal to their current fair value on the repurchase date. Is it right? So you can purchase it at what price? A price equal to their current fair value on the repurchase date. Means whatever will be the market price, at that price you can purchase. If market price is say 300 rupees, you will buy at 300. If market price is 200, 200. Market price is 1000, you have to buy it at 1000. So my question is whether entity A should derecognize this investment sold. There is only one answer. Either yes or no. There is no depends in this example. You have to see whether entity A has retained the risk and reward or it has transferred the risk and reward to the other entity. Transferred. Why it has transferred? Suppose after 3 months the price is 1 rupee only. So you will buy at 1 rupee. So who will suffer the loss of decline? The other party. Suppose the price is 5,000 rupees. So you will have to buy at 5,000. So who will gain? The other party. So who has been now exposed to risk and reward? The other party. And secondly, there is no necessity that you have to buy this asset now, because it is at the market price. It is at the market price. So two things you can write for the answer. One, risk and reward has been substantially transferred to the buyer. And second, there is no necessity that the asset will be purchased by you because it is at the market price. You are not going to get any benefit from, any additional benefit from that. So the answer you will write like this. Entity A should derecognize the transferred asset because it has transferred substantially all the risk and reward of ownership. While entity A has retained a call option. Now this is given to confuse you. Retained a call option does not necessarily mean you are going to buy it, and second, you are going to get benefit out of it. While entity A has retained a call option, the exercise price of this option is current fair value of the asset on the repurchase date. So it is not deep out of money or deep in the money. It is, you can say, add the money. It is add the money. Normally add the money means market price and exercise price are equal. Therefore, the value of the call option will be close to 0. When exercise price and market price are equal, the value of the option is 0. Market price minus exercise price is the formula for call option value. So 0. Accordingly, entity A has not retained any significant risk and reward of ownership. Okay, now solve one question. It is printed in your notes. What is that question number? There is a small change you will do. ASF Limited has lent a sum of rupees 1 lakh. 1 lakh at 18% per annum for 10 years. ASF Limited transferred its right to receive the principal amount of the loan on its maturity. So what it has transferred? Principal with and the right to receive 14% interest per year. So they have transferred principal, they have transferred 14% interest out of 18, 14%. Of the balance 4% interest, 2% is due to the transferor, that is ASF Limited, as a service fees for collection of principal and interest. So ASF Limited will be given 2% for collection of principal and interest. The expected cost of collection is 800, write down 800. Expected cost of collection is 800. So this time you will have to find out the fair value of the service asset also. So fair value of service asset will be present value of cash flow. Cash flow will be interest 2% minus expected cost of collection. So net cash flow will be discounted. So in this question we are going to calculate the fair value of each component, which some time back it was given to you. ASF Limited has retained the right to receive the remaining 2% interest per year. So this is the division of that 18%. Out of 18, 14 is transferred, 2% will be treated as service asset, as a fees for collection of your principal and interest, and 2% is the interest you have retained with you. Show the journal entries to record derecognition of the loan, assuming expected yield rate is 13% per annum. Okay. So what we will have to do, first we'll have to find out the fair value of components. Which are the components? Principal, fully, interest, 14%, service asset, 2% subject to collection expense of 800, and 2% interest strip retained. 4 parts. Principal will be only collected in the last year. Interest for entire 10 year. Service fees for entire 10 years. Is it right? For discounting purpose. So write down in your notebook, first we'll write down calculation of fair value of components. There are 4 components. Interest transferred, principal transferred, interest retained, and service fees. Any way you present, you just give me the final answer. This is one way to present. After writing the heading, we'll first write down point A, cash inflows. Cash inflows. You have transferred interest, 14% of 1 lakh. Just check, is it 14,000 per annum? Say yes or no. Then principal, 1 lakh. This also we have transferred fully in this problem. Interest retained is 2%. 2% of 1 lakh, 2,000. And service fees 2% of 1 lakh. 2% of 1 lakh, 2,000. But you are going to collect, in the process you are going to incur some expenses. So we will calculate the service fees net of any expenses. So point number B, write down cost of servicing the loan. Cost of servicing the loan. If it is given, you do it, otherwise ignore it. 800 rupees in the last column only. So point number C, write down net cash inflow. 14,000, 1 lakh, 2,000, 1,200. And then you write down, next line, year. This 14,000 you will get for 10 years, 1 to 10. This 1 lakh is the cash flow of the 10th year, correct? Say yes. Louder. Yes. This 2,000 you will get for 10 years, 1 to 10. And this 1,200 also for 10 years. Because to discount it, I require here annuity factor, present value factor, annuity factor, annuity factor. Now next line, write down E, annuity factor or present value factor at 13%. Check the calculation. I have not checked. 10 year and 13% annuity factor. Is it 5.43? I have not checked. Somebody told me, I have written. Only 10th year factor. 0.29? And then copy 5.43, 5.43. Don't calculate again. If this is right, then this is same. Now, dear student, multiply C into E. C into E will give you fair value of components. C into E. Round up the last digit. 14,000 into 5.43 है जी 76020. Is it right? Continue. 1 lakh into 0.29. These are the questions they ask in the exam. 29,000, 10860 and 6516. Is it right? In this ratio, you will divide that 1 lakh rupees value. So that will help you to find out the carrying amount of individual components. Okay? So dear student, write down apportionment of carrying amount. Apportionment of carrying amount. First you write down the format, serial number, particular, fair value, carrying amount. Serial number, particular, then one column just for taking the total of these two items, because these two we have transferred, so I can just do one single calculation, and these two I have retained, and this is service asset. This I have written, this is service asset. So I am going to expect answer from our student. Carrying amount, divide in this ratio. First check the total 122,396 is right. Have you checked? Right. Now solve. Try. Okay, check the answer. First answer is 85803. No. Approximately. Second answer 5323. 5323. Third answer balancing figure 8873. Total check. Is it 1 lakh? This 1 lakh we have to divide into three parts. 85803 transferred. 5324 is service asset. This is the fees for collection, and this is interest strip retained. Done? Wait a minute. Interest transferred is how much? This two number is not right. This one. Okay, these are interchange. Okay, while writing, you should write 29,000 here and 76,020 here. Okay? Good. So you are learning. Now step 3, journal entries. What we will do, as I have written in the notes, first you divide the loan into different strips. Sold strip account debit 85803, journal entries. Servicing asset account debit 5324. Interest strip account debit 8873. interest strip account debit 8873, to loan account 1 lakh, to loan account 1 lakh. To loan account 1 lakh. Being loan split into strips. Being loan split into different strips. Okay. In the exam, if they ask journal entry, you have to write narration also, but very briefly. And then this portion which we have sold was sold at a fair value of 105020. Just check. 105020 is there in the total column. Fair value, first and second, principal and interest. Bank account debit 105020. This is what we'll get. And the book value we will derecognize is 85803. And to profit and loss gain on securitization 19217. Is right 19217? Say yes. Yes. Now search for this question also. Is it there? One more last chance. 10% loan amount is how much? Amount is written? 8 lakh. 8 lakh. Time? 3 years. A Limited securitized principal strip 40% along with interest write-off 7% on total principal. Is the wording clear? So what portion of principal is securitized? 40% of 8 lakh? 3,20,000. 7% of total principal. How much interest is securitized? 7% of 8 lakh? 56,000. So what is retained by you? 60% of 8 lakh? 4,80,000. And how much interest is retained by you? Total interest is 80,000 rupees. 56,000 you have securitized. So 24,000 rupees retained. Is the cash flow clear? What is retained and what is shifted? Yes. Discount rate is 14%. Is it written journalize? Yes. One more thing, right? Prepare ledger account. Written? Yes. So now I am going to tell you how to prepare ledger account also. Normally they don't ask ledger account in the exam, but past is not the guarantee of future. Please read the prospectus carefully. Okay. Calculation of fair value of the strip sold and unsold strip. What is the discount rate they have given in the last line? 14%, okay. So I hope you have understood these numbers. Year sold strip, present value at 14%. Unsold strip, present value at 14%. Once you start understanding, you can save time by reducing the working note. Otherwise, we will prepare 2 working notes when we started the chapter. And now when we are towards the end of this topic, we have done in 1 working note only. 56,000 you understood? No. 8 lakh into 7%. 3,20,000, 40% of 8 lakh. Unsold strip is 80,000 minus 56,000, 3 times, and retained is 60% of 8 lakh. Now take your calculator, 56,000 divide by 1.14 equal to, tell me, 49,123. Again press equal to 43,090. Press equal to again. 37798. Sure. Then type 3,20,000 divided by 1.14 equal to 3,20,000 divided by 1.14 3 times equal to, yes, come on, 2,16,000. First ladies first, 2,16,000. 2,16,000. Okay. Now your answer. 2,15,991. My God. I thought there is a huge difference. For 9 rupees you made me work so hard. Okay, tell me the total. Total at this, no problem. Both are allowed in the exam, don't worry. Institute is not that rude. 3,46,000. 001 2. No problem. If you want to write, then write properly only. It should match. 3 plus 8 plus 1, 12. So it should be 2. Okay, now try this one. 24,000 divided by 1.14. 21052. Again press equal to 18467. Again press equal to 16,199. Okay. 4,80,000 divided by 1.14. Press equal to 3 times. 3,23,986. 323,986. Tell me the total. 3,79,705. Is it right? But it's not consistent. The last digit is not making it 5. Anyway, go ahead. 706. Step 2, write down. Book value of the strip sold and strip unsold. Book value of the strip sold and strip unsold. So first you tell me again, what was the fair value of the strip sold? It was how much? 3 lakh? 3 lakh how much? 46,002. And this was how much? 3 lakh? 79,000? 70? And what is the total of these two? 725? Okay. Now you please apportion this 8 lakh in this ratio. Take on your calculator 3,46,002 upon 725,707 into 8 lakh. Into 8 lakh. This number divided by this number into 8 lakh. Answer. 381, 423. To save time, this you put as a balancing figure. Okay, 8 lakh minus this number. 418577. Is it right? 418577. So this is the book value. Have they asked you to pass journal entry? So journal entry will pass only at the time of derecognition. So write down journal entries. Now you'll get a good idea how the whole accounting moves. Okay. So write journal entry, date, particulars, debit, credit. Sold strip account debit. Sold strip book value, tell me. Book value. Haji, book value. Wait. You are getting confused. 381, 423. 381, 423 and unsold strip book value 418,577. To loan account 8 lakh. To loan account 8 lakh. You have to solve such questions. There is no choice. Then next is bank account debit. What is the fair value of this sold strip? Now you tell me fair value. 346,002. And the book value is 381,423 here. So what is the loss on securitization account debit, means P&L account? 35,421 loss on securitization, and to sold strip account 381,423. If they ask you only journal entry on the date of derecognition, which we did in most of the other problems, you will stop here. But if they ask you to prepare the sold strip and unsold strip account also, then we'll prepare the ledger also. Draw the format. 3 formats you will draw. First you draw loan account, 5 lines. Date particular rupees, date particular rupees. Then you draw sold strip account, 5 lines. Sold strip account. Keep 5 lines gap, that is enough, only 1 year. But below this you draw one more account, unsold strip account. Unsold strip account 15 lines. Why 15? Because that has a 3-year life. So for 3 years we have to pass entry in that account. For 3 years we have to pass entry in that account. I want to close that account also after 3 years. Is it right? Have you drawn? Loan account, sold strip account, unsold strip account. Now I will write, pay attention, loan account, first you write down 2 balance brought down. What is the balance on the date you have securitized? 8 lakh. Is it right? And then you have passed 2 entries on the loan account. One is by sold strip account and by unsold strip account. Go to your journal entry 1 and tell me how much amount you have written sold strip account debit, unsold strip account debit to loan account. 381, 423 and 418, 577. Take total as homework. Come to next account, sold strip account. Debit side write down to loan account. To loan account 381, 423. Credit side by bank. How much amount you received for this sold strip? 346,002. And by loss on securitization, or directly write by P&L account. P&L account. How much was the loss? 35421. So this account will also close. Any query so far? Then you go to below this, there is an unsold strip account. Unsold strip account, write down on the debit side to loan account 418,577. Have you written? 418,577. Now you have to find out the revised effective interest rate. So below this, keep 15 lines blank. You have kept 15 lines blank. And then in order to close that account, you have to find revised EIR. You have to find revised EIR. Okay? Otherwise that account will not close. We have to close the account on its own. So now write down calculation of new EIR or new IRR. Okay. So in this chapter, what will be the problem now in securitization? After the securitization, you have to recalculate the EIR on the basis of whatever cash flows that you are going to get in future now. Now year 0, which figure you will keep here? Year 0. First draw the format. This figure 4,18,577. This amount you are going to recover over next 3 years. 418,577. And you are going to receive following cash flows. You are going to receive these cash flows 24,000 and 4,80,000. Is it right? 24,000 you are going to receive 3 times, and third year you will receive 4,80,000. What you have retained, I have written here. Tell me discounting factor for 10% and 1-3 year. 2 point. 2 point? Louder. 4,869. Okay. And only for the third year. 7513. 1213. Welcome. Now multiply 24,000 into 2.4869. 59,686. And then 4,80,000 into 0.7513. 3,60,000. 600 and total. After taking total of positive number, deduct negative number. 1733 positive, which means I have to increase the rate. So take 11% here. Take 11%. If it was negative, I will reduce the rate. If the number is very high, I will increase the rate by a higher percentage. Is it right? This is something which you have learnt in financial management subject. So dear student, kindly respond 11% 3-year annuity factor. 2.4437. Again, only third year. 0.7312. Multiply 58,649. And last one 350,976. Tell me the total. 8952 negative. Very good. So you can guess that the answer is between the two because I need 0. So formula for EIR, take the lower of the two discount rate 10 plus NPV at lower discount rate 1733 upon change in NPV 1733 plus 8952 into difference in discount rate 11 minus 10. 10.162. Okay, that is enough. 2 or 3 digits after decimal is enough. 10.162%. Now this is the effective rate at which we will recognize the interest income. Is it right? So come back to this. Unsold strip account debit to interest income. $418,577. This is year 1. What was the percentage you told me? 10.162%. Okay, 162% into 418,577. Round off. 4253. And by bank. By bank, anybody, how much? How much cash flow you will receive? Cash inflow 24,000. We are not doing it for the first time. Yesterday We spent the entire lecture on this only. And by balance carried down, 437113 approximately. To balance brought down, just 5 minutes more, not even 5 minutes. 437113 to interest income based on effective interest rate 44419. Year 2 by bank cash inflow 24,000. By balance carried down 4575. Okay. 457532. Right or no? Year 3. Now we have to check whether what we got was right or not. To balance brought down 457532. Wait. Now on the credit side by bank, you will receive 24,000 plus you will also receive your share of principal. Your share of principal is how much? 4,80,000. This is what you have retained. You will get it. 5,04,000. So now to interest income balancing figure 46468. Now just cross check whether if you take this number into 10.162%, how much you are getting? 46494. Some difference will be there because 10.162% is not an accurate IRR. Is it right? But at least this account gets closed by using effective interest rate now. Now we'll continue tomorrow.